you look at the number of funds or fund managers actually outperform regularly, and this goes back to the losers game, Charles Ellis again, there aren't many. And I think that the missing link in the way that we've done things is this recognition of the psychology of our decision making. There's a kind of growing awareness that the industry isn't quite as smart and clever as we once thought it was. Occasional good outcomes have masked a bad process, and people have been lucky. They've got 3 or 4 years of good performance behind them, which could be skill, but could be luck. But you probably need more than that to determine whether it's more likely to be skill or luck. The Simon and Garfunkel song, still a man hears what he wants to hear and disregards the rest. Confirmation bias, eh?
Welcome to the AlphaMind podcast, where we seek to explore, examine and illuminate the mental, emotional and behavioural aspects of trading and investing. The AlphaMind podcast is co-hosted by Stephen Goldstein and Mark Randall. Our mind doesn't always lead us to make choices that are in our best interests. The primitive, emotional parts of our brains have a powerful influence on the choices we make. And when we make decisions, we are not always as in charge of them as much as we would like to think we are. Often, our emotions, in the face of the extreme uncertainty, volatility, complexity and ambiguity that characterises life in trading and investing, gets the better of us, and we fall back on default and often subpar decision making. This week, our guest is Paul Craven, an expert in the field of behavioural finance who talks, lectures and has a deep passion for this topic. Paul understands the challenges people in these fields face, having spent a career in the industry working for leading firms such as Schroder's Investment Management, PIMCO and Goldman Sachs. We think you are not only going to enjoy listening to Paul, but you will be entertained and informed by him too. Before we start, a quick word about our podcast sponsor. Understanding price action, how and why the market moves, and analysing it to generate insights and ideas is a key component of successful trading, whether it is discretionary or whether it is part of a system building process. The Society of Technical Analysts online home study course is the gold standard in taking your knowledge and skills to the highest level in this area. It is based on their outstanding diploma programme, which is delivered at the world-renowned London School of Economics, and which has been created and produced by some of the world's leading figures in the field of technical analysis. We're delighted to be able to offer listeners to the AlphaMind podcast access to this program at a discounted price. To find out more, visit the AlphaMind blog, alphamindblog.blogspot.com, and go to the page link STA Home Study Course. Now on with this week's podcast.
Well, welcome to this edition of the AlphaMind podcast, and we are delighted this week to have Paul Craven with us. And amongst being part of the magic circle, he's a behavioural economics expert with history spanning back to the 80s, a good spell at Schroder's, PIMCO, Goldman Sachs. But he's changed his world around and switched a Surrey-based home to a Kent-based home on the sea, and now faces the world as a recognised speaker in the field, but also a coach of ascents and a thought leader in the space. So, Paul, welcome to the show.
Well, thank you very much indeed, Mark and Steve, for having me.
For our audience, which is extremely varied and some quite new to this space, perhaps just give us a start off with behavioural economics.
Yeah, it's a term I have to say I have some suspicion of, and some people use the phrase behavioural economics. Some people like to use the phrase behavioural finance when they're in our space in markets, and some people prefer the more generic behavioural science. Essentially, my favourite definition of it is how real people make real decisions in the real world. And why do we emphasise the word real? Because I think there's a school, and I'll dare to call it traditional economics, that says that people should behave in a certain way. People should be motivated by certain things. People should be incentivized. People are generally logical, rational, analytical, etc., all those things. And I think what behavioral science uncovers is they can be all those things, but actually often they're not. And often, to use the phrase of Jonathan Haidt, the emotional tail wags the rational dog. Often we overcome our logic, our analysis, the sort of neocortex way of thinking, the part that we think we're really smart, the Homo sapiens bit, and actually we revert more to instincts and emotions. And I think what behavioural science does is uncover those, and we can use it in a very good way. And for example, I've in my career, I think there's really two parts to my career. One is as a portfolio manager, which was for the first half of my career when I was at Schroder's. And then more latterly, in the second half of my career, I was more involved with business development and sales. And I found behavioural science to have been really useful in the field of investment. And I guess that's what we're going to talk about mostly today. But actually also, it's really important when it comes to communication and connecting, particularly with your clients. And so, yes, I do a lot of public talks and workshops and things on investment coaching or investment enhancements you can make using behavioural stuff. But I also do lots of stuff involving how to be a better salesperson, how to be a better communicator. So I found it really useful in two areas of my life in the last 30 years.
Okay, well, welcome to the session today, and I'm particularly fascinated to have you on. I've been a huge fan of the field of behavioural economics, behavioural finance for many years, and I also do actually lecture on the Society of Technical Analysis diploma on behavioural finance. Although it's a one-off lecture and it's very introductory, and I don't think I'd consider myself qualified to teach beyond that. But it is an amazing area. I'm a huge fan of the different schools within it, the biases and heuristics school, which is the Daniel Kahneman side, and then the more naturalist decision-making field of Gary Klein, which is probably where I lean to. Because that kind of really, for me, that's about real people making real decisions in the real world. And that's what they focus on, rather than the other side, which is still a little bit laboratory focused in terms of, how we should be and how we versus how we really are. Wonder if you had any thoughts on that.
Well, I think you raised a very good point, and it is a point of discussion in the behavioural science world is what does the word rational mean? And I think you highlight the fact that there is a sort of strong body of thought, and I think it's probably pioneered by Danny Kahneman, that biases are essentially irrational. Whereas I think there's a more kind of approach taken by the Gary Kleins of this world, the Gerd Gigerenzes of this world, that says, hang on a second, if they're there as a hardwired bias or heuristic, which we've evolved in our brains to have over, well, pick your number, 200,000 years, 6 million years, whatever you want to do, it's probably there for some good reason. And so let's not jump at this idea straight away that a bias is irrational, because actually in the ancestral environment, for want of a better phrase, a lot of biases make very, very good sense. Let's just go through a couple of them that affect our world in investment. The herd instinct, or the bandwagon effect. Now, you and I know that as being something very dangerous in our world, and we'll perhaps call it irrational. People just pile on and buy things because other people are buying it. It can create a bubble like the tech boom in the late 90s, or whatever bubble you care to look at, tulip mania back in hundreds of years ago, South Sea bubble, doesn't matter. We've seen lots of bubbles, and they look irrational to us, don't they? And we say, well, that's the herd instinct in action. That's the bandwagon effect. The idea being we see what other people are doing. We're slightly envious of them. We're worried that we're missing out. We jump on board their bandwagon and we drive prices up to unsustainable levels. The bubble then crashes. There are no more buyers left. Boom. And it can affect the economy and recession and so on and so forth. And that all seems to sort of qualify under the word irrational. However, let's look at that bias. Let's look at that short mental shortcut, the bandwagon effect. It actually makes great sense in evolutionary terms. It's what kept our DNA going for those millions of years. It's the idea being that we do group together, we do herd together, we do interact and copy each other's successful behaviours. And by doing so, it's kept, as I said, it's kept yours and my DNA going for millions of years because people have done that successfully. So the point is that some of these so-called biases or heuristics, mental shortcuts, can only possibly be seen as irrational when you put them in the wrong environment. And let's face it, a financial market is an artificial modern environment. But in most cases, these biases make absolute evolutionary sense. And I'm a great believer in evolutionary psychology. I'm just finishing a book at the moment, The Ape That Understood the Universe, by Steve Stuart Williams, which I would thoroughly recommend to anybody, The Ape That Understood the Universe, which talks about, again, a lot of evolutionary psychology and why we do and behave the way we do. and it's fascinating. So I'm always nervous about this idea of using the words irrational in behavioural science context, because I just want to be careful about it. A lot of them make sense.
Yeah, I mean, it's a very loaded term, I always found, because, what's rational to one person is irrational to another person in another context. So it comes full of loaded with judgment and context, circumstance, dependency. I mean, I've always felt that actually the emotional finance, which is the area of people such as David Tuckett, it is perhaps actually a better term. And I mean, I love the work of some of the people in that field. And it kind of brings together, I know behavioural finance has become sort of the catch-all term, but it brings together all these fields like evolutionary psychology, sociology is in there, different fields of psychology, how the mind works, neuroscience. So many different elements and disciplines come together.
And chucking good old-fashioned history in there as well. I mean, I'm a historian by training, or I read it at university at Cambridge, and I think that when I'm asked, when my first interest in behavioural finance came about, it's because I'm a historian, and I just like looking at what happened previously and seeing, are there patterns there? Are there things we tend to do? Human beings make similar mistakes. Mark Twain allegedly said, I don't think he ever did, but he allegedly said, history doesn't repeat itself, but it does rhyme. And it's interesting when you look back as a historian, let's say the stock market bubbles, since we talked about those a little bit earlier, to see how many similar characteristics and patterns there are. And I think the reason probably is that the human mind hasn't changed massively in the last few hundred years in terms of learning from its mistakes. And I think the one thing that history does allow us to do is to look back on what happened previously and say, can we learn from our mistakes? And when I look at financial markets and I see the different cycles, or certainly the booms and the busts in my 30 years, it seems we don't learn very well as an industry, but that's human nature for you.
Yeah, it's interesting, isn't it? Is it a case that do you think that if you've made a decision that's making money, but it's a rational situation, if it starts to lose money, it becomes irrational, and we start to look at excuses as to why it was irrational?
Yeah, I have heard, and I hope I haven't done this myself, but I have heard quite a few portfolio managers in my career say the market is wrong. And it's okay to say that, but it's also very, very dangerous. So if a position goes against you, and again, this would apply as much to the trading world as the longer term investment world, just be careful when you start saying the market is wrong, because it's got a lot of capital behind it and a lot of time as well. And I think that actually brings me on to sort of one of I think the big lessons for me, and again, I've worked for three great asset managers and been lucky enough to enjoy that and learn from them, and also learn from my mistakes. I think that time is a really interesting factor when it comes to investment. And again, your time frame of, say, traditional traders may be very different to my one, where I've looked at long-term institutional pension funds, where the time frame must be longer. But I do think that if people are patient with investments, if they're allowed to be, what's their mandate, what's the portfolio, what's the benchmark, etc., which is why pension funds naturally lean towards longer-term investment, then the old adage that markets perform over time, not all the time, is very useful. There does seem to be a history of stock markets going from bottom left to top right of a chart, but you have to wait a long time sometimes to see that. But if you have the luxury of time, then I think it was Aristotle said, patience is bitter, but its fruit is sweet. So one sort of behavioural lesson that I always like to remind myself is, volatility is the price you pay for long-term returns. I think that's something that Morgan Housel talks about in his recent book, The Psychology of Money. Volatility is a price you pay. And if you are a long-term investor, you have to pay that price. If you're a short-term investor, a trader, I'm guessing that's part of your opportunity, the volatility. But again, that's not so much my world, it's more your world, I think.
Yeah. And that's an interesting aspect that, your style and approach and your personality, which is an area we look at a lot, will define how you cope with volatility. And some people obviously use volatility as, I suppose in a sense, all people use volatility as an input into their trading. The higher the volatility, often the higher the reward. But the harder it is to stay with it.
It is, and it reminds me of one of my favorite quotes about investment, although it was never said about investment, actually. It was said about flying. It was done, so it became apocryphal as an early quote for those flying instructors. And I'll give you the quote as a flying quote and then give it to you as an investment quote. There are old pilots and there are bold pilots, but there are no old, bold pilots. So let's put that into our words. There are old investors and there are bold investors, but there aren't many old, bold investors. And I think that's very important to remember that. Boldness probably is better in the sort of trading world in one sense, but it's if you're a long-term investor, I think you've got to be very careful. And I actually come from the school that takes a lot of the behavioural lessons from this idea of Charles Ellis's winning the loser's game. And I'm sure many of your listeners will know this. It was originally, I think it was a six-page paper printed in 1975 by a young Charles Ellis in those days. And he essentially looked at all the mutual funds he could find in the States, it was, and looked at what made a successful long-term investor. And he concluded that net of fees, and again, this was 1975, that at that point, the industry was struggling to show value. And the reason was, he surmised, was because actually investment isn't most people on average lose over the long term. And so he wrote this paper called Winning the Loser's Game. Investment's a losing game. So how do you win at the loser's game? And I think it was a brilliant paper. And it was kind of before behavioral science became well known, but it is actually a behavioral science concept. He said the best way to win is not to lose. And to explain what that means, he said it's a bit like playing tennis, and he likened it to amateur tennis playing. If you're playing tennis, you want to get the ball back. That's your first instinct, to get the ball back. And if you count up the number of points that you or I win if we play each other at tennis, the odds are on that if I'm playing you, Steve, at tennis, the points I've got will be when you've hit it into the net or over the end of the court, right? And vice versa. There will be the odd occasion when you'll do an amazing ace and beat me with a winner, and I'll do a cross-court volley and beat you with a winner. But most of our points are won by the other person losing it, by our opponent losing it. So Ellis really built on this concept and said that having looked at the investment world, too many investors are trying to smash the ball, effectively, trying to serve the ace, trying to do that amazing shot for the winner, whereas they'd be better at getting the ball back. And he backed this up with one of the data. He subsequently turned this paper into a book 20-something years later, and I think the book gets revamped every year, gets updated every year. And his big conclusion is if you stick around as an investor and you play time properly with a bit of patience, you can take risk. He's never saying don't take risk. What he's saying is don't take too much risk relative to your time frame. And so you can end up sort of being sort of third quartile, quarter by quarter, whilst others are shooting the lights out and being first quartile. But the odds are on they're going to start trying to smash the ball again too much and start drifting down. Or what often happens, if a fund manager, I won't name any names because there are plenty in the headlines about people who get successful, they attract loads more money into their firm. They might change their philosophy. They might start investing in things they've never invested in before in order to get this money invested. And guess what? The shine comes off and suddenly they go from superhero to collapsing. Yeah,
superhero.
And so that's exactly what Ellis is saying. Don't do. Stick to the gun. Stick to your simple philosophy. I think he's saying also don't take on too many assets, because I think that can be problematic in terms of a firm. Because then you become an asset gatherer, not an asset manager, and that nearly always causes problems when that happens. And so that's where that sort of idea of Charles Ellis is concerned. Win the loser's game. Try and win the loser's game by not losing. Get the ball back. And he also, dare I say, he didn't just look at tennis, by the way. He looks at military history, looks at examples from that. And again, people who tend to avoid losing do very well over the long term as outright winners. He looked at flying, and I mentioned the bold pilots comment. And it's kind of served me well, that philosophy. But I didn't know at the time when I first read this paper in '86, Winning the Loser's Game. But actually, it's if you think about it, it is actually it's a pretty good behavioural trait: patience, time, not reacting, not trying to do something that isn't part of your speciality, your expertise, knowing your circle of competence. That's a great Buffett Munger concept.
Yeah.
But again, Ellis was saying this thing in 75. They're not using those exact words. And actually, to be fair, it's not a particularly modern concept. I mean, Charles Darwin. There's a phrase in Charles Darwin's book, which I pull out, and I think it's just brilliant from an investment point of view. For the shield may be as important for victory as the sword or the spear. And so let's not think about investment always being about attacking. It's as much about defending and being around tomorrow to play the game tomorrow. And that's kind of my interest in. That's going to be a historian and a bit of psychology thrown in. That's a bit of background to why I love this stuff so much, and I think it helps you as an investor if you can just grasp those concepts. They're simple to grasp, but they're very hard to do because, as you pointed out, when volatility is occurring and markets are collapsing, you kind of feel I must do something. I must buy or sell or do something.
The impulse to do something is so strong, and I mean, the world of trading and the world of investing is, it's really just a spectrum. They're different forms of speculation, and you can almost, go back to gambling as being on that form as well. But obviously investing is something which happens over the long term. But it's fascinating hearing you talk, and you reminded me of one of my favourite quotes, which was by a blogger I read many years ago who went by the name Phantom of the Pits. So I never knew his real name. But this always stood out for me. He said, in trading, the biggest winner is the best loser. And I just thought that summed up trading.
Oh, I like that. That could go into my talks. Thank you very much. Thank you very much indeed for that. That's brilliant. And it's so true. Here's a thought for you. Just sort of trying to link that back to the idea of winning the loser's game and some of the psychological concepts behind behavioral finance. I'm drawn very much to the idea that behavioral science or behavioral finance gives you the ability to try and look at events, your thoughts, decision making, whatever you want to look at, from a different perspective. And I noticed that in your recent podcast with Gary Klein, you talked a lot about something I know you do, Steve, pre-mortems, which I think is a fascinating psychological exercise. And I don't think enough of us do it as investors. And I don't think enough of us do it anyway with major decisions generally. And I almost come back to this idea of how many of us, when we've come up with an idea or a theory, and it needn't be about investment, it could be about anything in life, marriage, getting a car, but whatever. How many times have us actually asked this question, where could I be wrong? Or where could I go wrong? It brings us back to, one of the dirty dozen of the worst investment biases, I think, as I sometimes call them, confirmation bias. The idea being of, once I've got an idea, what I tend to do as a human being is I tend to find supporting ideas or facts or evidence for that. I also like to surround myself with people that tend to agree with me. That tends to be another feature of confirmation bias. And I don't tend to think of how the hell could I be wrong here, and what could possibly. And I think the best investors that I've met in my 30 years ask that question. They do ask the question, where could I be wrong? And it sort of gets into a little bit of the pre-mortem concept. But I love this idea of challenging one's own confirmation bias. And I see confirmation bias all the time. It's probably the bias, as I say, it's the number one bias in the investment industry that I've watched out. I try and watch out for when I'm working with clients, largely because it's so natural, it's so human. I mean, you don't go up to your boss and say, look, we must do this, but let me tell you why I might be wrong. Because it's kind of career limiting if you start behaving like that, and reeks of underconfidence. But the problem is that I think too many of us then try and filter out stuff which might give clues to that. And what was it? The Simon and Garfunkel song. Still a man hears what he wants to hear and disregards the rest. Confirmation bias, eh?
Every time I hear that song, when that line comes up, I think that is confirmation bias.
It's
You
but
know,
yeah,
it just jumps out at you.
it does, and it's so good, and it's so right, and uh, and then actually there's actually was there was someone one of the behavioural folk a few years ago decided to try and come up with a behavioural science playlist for Spotify, which they did, and they didn't have that song on there, which I just felt didn't have the Boxer on there by Some of Our Funkles. So I immediately told them, "You're missing the best line ever in the history of popular music about confirmation bias. Still, a man hears what he wants to hear and disregards the best."
And did he reject it?
I can't remember what happened now. It was a long time ago. But it was, but the confirmation bias thing is something, and I'm sure that you come across it in your work as well. It's one where people just will not. Will not sounds a bit out. Are not able to see where they could be wrong, and therefore just plough on regardless. And it obviously can be linked to overconfidence as well. And I like to look for, when I'm lecturing on this or doing workshops on it, I like to often give people examples from other fields, not just finance. There's lots in investment, obviously. And to give you two or three of my favourites, one of which I was once on Question Time in the audience, I might point out, not on the panel, which for those of you who don't know is a BBC political show where you have five politicians or political types in a panel, and they get asked questions by the audience, and then they each try and answer them. And I actually went on the show in 2015, and it was filmed quite near me in Dover, and it was a particularly hostile crowd, it felt to be, and a particularly hostile panel. I mean, you can go back and find it on YouTube. It's really quite exciting. And there was a extraordinary spat between Rod Liddle, the journalist, and Simon Sharma, the historian. And it was actually, these were pre-Brexit times. It wasn't even that Brexit was getting people riled up. It was on immigration. It was just after there'd been that terrible, you probably remember, terrible photograph of a little child who'd been a refugee a child had been drowned and washed up on a beach, and they were absolutely shocking. The world was shocked, and then Angela Merkel said, we'll take as many immigrants as possible, migrants as possible, I should say. And there was a big debate about, is that a good thing to do or a bad thing to do? It's obviously seen to be sort of the right thing from a humanitarian point of view, but could it cause more problems than it solved? So this was the debate, but it wasn't really a debate. It was a shouting match. And Rod Liddle said something that made me think, actually. And again, I often listen out for these behavioural phrases. He said, we must not do the wrong things for the right reasons. And that made me think about a lot of things that I do, what outside of finance, are we doing the wrong thing for the right reasons? And I was that night particularly taken by my own personal example of confirmation bias. I've never seen anything like it. I was sitting next to two people in the audience, and it didn't matter which panelists was speaking. Didn't matter whether they were Labour, Tory, UKIP, whatever they were in those days. The woman next to me was shouting out one word, whatever answer they gave, and that one word was fascist. Literally, she was going, fascist, fascist, and then her friend would say, "Shame on you, shame on you." And I remember thinking to myself, do I tell them to shut up and just listen to what is hopefully going to be a debate, or do I just let them shout out fascist every question? And I decided just to shut up and listen and try and listen to the debate, which was pretty heated, whilst being interrupted in my left ear by a woman shouting out that. So pure confirmation bias, no interest in changing their minds, no interest, and the audience pretty much made up their mind before they went in. I don't think many people were swayed by it. And when I look at social media today and the polarizing nature of social media, from a behaviourist point of view, I'd like to find someone whose mind has been changed by being shouted at on social media, because I don't think there are many. I think you plant your flag, and people plant their flag and they get behind it and they shout at the other side, and it's pretty waste of time, really.
And that really brings you back to a major point of being a trader or being an investor, is that actually you can't hold strong opinions. You have to be willing to change them when the information, or the fact, as the famous phrase attributed to Keynes says, when the facts change, I change my mind. What do you do, sir?
Yeah.
And I was recently reading Fooled by Randomness again
Yeah.
by Nassim Taleb, which is one of my favourite books for traders and investors. Not always the easiest to read, I'll admit, but I always feel it should be essential reading.
I find that his best book, by the way. I've read them all, but that's my favourite one, Fooled by Randomness.
Me too, me too. But there's a great part later on in the book where he's talking about Soros, and he's talking about an apocryphal story about Soros that was told or related in a book, where it was saying that he had a really strong view on something and had completely structured his trading or investment view or position around this view. And then other people were following him who were working in the same firm at the time. And then one day he just came in with a completely different view and a completely different position. And these people were really annoyed with him for just changing his view or opinion like that. But what Taleb said was part of his genius was that ability to have a view, even express it quite strongly, and then the very next day just change, do it a complete about face.
Yeah.
And I think that's something which, great traders and great investors are able to do. Many of the best people that I've met, they may express a view, but they don't hold it too strongly. They're always willing to challenge their bias, their narrative.
I think that's a brilliant point, and actually it leads on to a kind of the cousin of confirmation bias, doesn't it? Which you and I have seen a lot called the sunk cost fallacy. The idea being that we've invested some money, and it could be in a stock or a trade or a business. It hasn't gone well initially, but as you say, most people don't change their minds. And the reason they don't change their minds or find it harder to is because they've already put money in and they can't admit they made a mistake. And you can call it old-fashioned pride or unwillingness to admit I was wrong. But either way, it's a very strong natural human reaction. It's not to say, shit, I screwed up. And the sunk cost fallacy, I see it all the time because one of the things I also do now is I sit on investment committees of various pension funds. And so I get to see a lot of fund managers present to me, which is interesting. And one always is looking out for things like the sunk cost fallacy. So what do I mean by that? Well, if a portfolio manager says to me, I bought this stock and I'll make these numbers up, this is all hypothetical, 20% down, I'm never going to say what a terrible decision, because I know that happens. Markets can fall, you can be too early, and that's not what I'm there to do. I'm there to really try and understand better their cognitive processes behind their thinking about why they should buy the stock. And so I'm very happy to listen to the reasons why they feel it's a good buy, even though it's fallen 20%, for example. I'm giving an extreme example here to make the point. Now, what's interesting is that you can then ask, sometimes there have been cases where you can ask the same fund manager, look, if you were to set up a new portfolio today, a new pot of money, same mandate as your existing portfolio, would you buy this stock, the one that's down 20% in the other portfolio, would you buy it today for the second portfolio? Now, what will surprise people is that they don't automatically say yes. They sometimes go, well, no, well, maybe it's a bit early. They don't feel comfortable, in other words. And to which my response should be, I don't do this out loud, but why the bloody hell are you holding it in the first portfolio then? Because there's some cognitive dissonance going on here. They don't want to sell it from the first portfolio because it's below book costs and they've sunk money and resources into it and time, but they don't feel confident to buy it for the second one. And again, it's a hypothetical example, but I see aspects of this all the time. And again, this is not people being disingenuous. This is really important to point out. People aren't being sneaky or crafty or lying. In their head, they genuinely are struggling but they can just about get away with these two different thoughts that make sense to them. And so one of the joys about sort of doing these workshops and things is you get to sort of help trustees and investment committees pick these things out and try and help. And I use that not to catch out. I'm not trying to do that, but trying to help people cope with their cognitive dissonance a lot. And the sunk cost fallacy, this idea that I've already put money into a business or a stock, I can't therefore admit I was wrong, despite the fact the market's going against me. See all the time. You see it with people building new businesses that aren't working and continue not to work. It's sometimes called the Concord fallacy. Why? Because Concord was an example of a company in both public and private hands that never made money over many years, but still they kept sinking more money into it. And some people, one of my Greek friends says to me that keeping Greece in the euro is an example of the sunk cost fallacy. It's throwing a lot of good money after bad because it's going to come out one day, as indeed might some other countries, because it just doesn't make sense for a lot of the countries to have a single currency until there's full-blown European unification, which I think is a long way off. So, and I'm not making a political point now. I'm just saying factually, no currency union has lasted in history without full political union.
Don't go to Brexit.
No, I'm not going.
Never hear the end of it.
I'm not going there. I'm just saying, as a historian, there isn't an example
I know.
of it working for a large major union.
I know. You just reminded me of the few times where I've ventured to make a comment, say on some of my social media about something political, and I always regret it. We'll return to the podcast in a moment. The Society of Technical Analysts Home Study course is the gold standard in taking your knowledge and skills in technical analysis to the highest level. We are delighted to be able to offer listeners to the AlphaMind podcast access to this program at a discounted price. To find out more, visit the AlphaMind blog, alphamindblog.blogspot.com, and go to the page link STA Home Study Course. The Society of Technical Analysts is a not-for-profit body which provides education programs, regular talks, webinars, newsletters, and informative content for its members. Membership is open to all comers from across the world. Visit their homepage, technicalanalysts.com, to find out more. Now back to this week's podcast.
And in a way, though, it's pity because I'm happy to debate anything with anybody if we can be civil and do it. But the problem is that social media exacerbates this polarization, this confirmation bias. No one says, where could I be wrong? And
Ego comes into it so much, doesn't it? I mean, when we're talking about the sunk cost fallacy, is it really the money that's the cost, or is it the person's pride that's the cost?
I think you raised a very good point there, because it often is back to that Jonathan Haidt quote: "The emotional tail wags the rational dog." It is very emotional to feel if you lost money, and it hurts, and you don't sleep at night, or whatever it may be, and that does often overpower your more analytical type ways of thinking.
Yeah, but I don't even think it's the physical cost of the money. You made a great tweet just before you came on air today, which I just thought it was brilliant, and it just feels so right to read it out if I can. And you're not having a dig here at economists, by the way. I know that, but you say when an economist is wrong, it is called a revised forecast. When a trader is wrong, it's called a loss. A big difference.
Yeah. Well, I mean, I don't know who said that originally. I've heard different versions of that over the years, but I think it's very true. And indeed, I think, again, I'm not going to have a dig at economists, but what I will have a dig at is people that rely on macroeconomic forecasts to be the major reason for how they invest money. And let me give you some examples of that. I mean, if you had perfect foresight, so you met somebody who was a forecaster, so let's take it out of the word of economists, just say a perfect forecaster, who told you at the beginning of 2016 that this year we're going to have the Brexit is going to go through, which was 10-1 against. Trump will be elected as US president. Where do you think the markets will go? And I guarantee that if you'd known with perfect foresight what was going to happen in the macroeconomic and political worlds, you wouldn't have thought the markets would be up, what were they, about 20% that year? You'd have thought they would be down. So even if you've got perfect foresight when it comes to some of these forecasting macro stuff, it doesn't necessarily tell you how the market's going to behave, because markets don't work like that. And so I'm a bit nervous about people that I much prefer kind of more of a bottom-up type of investing as a general rule. I'm talking about fundamental investing here rather than technical trading, rather than people that believe in a sort of top-down thing. In fact, I believe that for most things, including the way to run governments.
Do you know what's quite ironic hearing you talk about that is at the beginning of January 16, I went out for a breakfast with a fantastic economist who makes his living as an economist, a private economist. And at the beginning of that year, he said to me, I think we're going to get both Brexit and a Trump presidency.
Wow.
And the odds were really low at those times.
Yeah.
Okay.
Yep.
And, he gave me his reasons why. And he said to me, then, where do you think the stock market's going to be? And I said, well, obviously it's going to be a disaster if, for the stock market. And he said, no, I think it's going a lot higher because of those. So he was right on all three things. But then I said to him, well, presumably you've filled your trading portfolio or investing portfolio full of stocks. And he went, oh, no. He was an Irish guy, by the way. No. I don't trade or actively invest. I'd be a terrible trader. He said, I'm far too emotional. So I don't get in it. I love what I do. I do this side. And he's, but I thought that was the most amazing thing. He is the most brilliant fundamental economist. This guy's got a great reputation in there. He does a lot of private work for funds. He doesn't work for any firm because he doesn't want to be tied to a particular organization. But he makes it clear that he knows where his strength is. He knows where his weakness and his passion is. And he says he's going to be too emotional. He'd be too emotional to be a trader, which really kind of, talks to that challenge of being a trader or an investor and the difficulty of almost trying to separate your ability to make good decisions from your emotional impulses.
Yeah. I'd like to give him some money if he sounds like a super forecaster to me, to use a Philip Tetlock phrase. It's a super forecaster. People that just can see things that others just have no idea of. Now, again, that could be luck, and I'm sure we're going to come on to discuss luck and skill in a minute, but it could be skill. And anybody who's got a track record in macroeconomic forecasting, please let them. I'd love to know who they are because I haven't found anybody yet that can do it over the long term.
Ever known economist to become a trader either. I can't name. I don't think I can name one in nearly 40 years I've been in this world. It's it's horses for courses, and it's professorial on one side, and it's high performance sort of.
By the way, I have got economists to thank for becoming interested in behavioural economics because I go back to, I don't know, I think it was when was it, the early 2000s, and I was actually in a pub with an economist or a couple of economists, and they seemed to be slightly irritated about something, and I said, what's wrong? And they said, this bloke Danny Kahneman's been given the Nobel Prize for economics. And I said, what's wrong with that? And they said, he's not an economist, he's a psychologist. And I said, and that immediately just made me go, wow. And my ears pricked up. Well, this is interesting. And I went away and found some stuff he'd written, which in those days was sort of academic papers and stuff, and became convinced over the following years from that, this would have been about 18, 19, 20 years ago, that behavioural science was a thing really worth flying the flag for, because I think introducing psychology into the whole equation, whether, as I say, but whether it be to do with investments or to do with selling, persuasion, influence, it's a really, really powerful tool to add to that. So I thank economists for showing me that, even if it wasn't quite what they wanted to say.
Well, the irony is that people, even Adam Smith and Keynes, they both brought a lot of psychology into their work. So it's kind of going back to its roots almost.
Well, actually, I'm always amazed that the Smith book, Wealth of Nations, is the one that everyone talks about, because it's the other book that is actually the interesting one, where he talks about a lot more about emotions and sentiment and things like that. And this isn't new, some of this. And in fact, I was just thinking earlier when we talking about the Simon and Garfunkel quote about confirmation bias. Thomas Jefferson actually wrote in 1787, the moment a person forms a theory, his imagination sees in every object only the tracts that favour that theory. So that's confirmation bias, right? And so it's not new, this stuff, and yet we still do it as investors and otherwise. It's fascinating. And it is one of the dirty dozen. And there are about 150 biases, so allegedly, but I think we think there's about. I work with a very good company called Behaviour Lab, that look at portfolio trades. They do the analysis. They quantify where investors, and these tend to be longer term investors rather than short term traders. I'd emphasise what sort of biases they might have, and you can actually quantify them. And what's amazing to me, when you start looking at some of the analysis of a fund manager's trading, for which you read investing, buying and selling and holding, is that you frequently see the same patterns. So in other words, you might identify a fund manager who he or she might hold on to a stock. They might identify a stock correctly as being good value, buy it, it goes up, and then they frequently hold on for it for too long, and it gets to the top and it starts to underperform the market, say. But they fall in love with the stock. They sort of champion the stock. It becomes one of their and all the good stuff that they might have held in the first 18 months where it did really well, they start to lose it afterwards. And again, I'm not saying that happens with lots of people, but you do see that sort of trait, and you see that trait repeated.
Is that the endowment bias or the endowment theory?
Absolutely. So, well, there's an aspect of that. So I own it. So if I own a glass, for example, or a cup, I ascribe to it more value because it's mine than if I was to see it in a shop window and think, what would I pay for that cup? So it's exactly the same, or it's very similar. But a lot of it comes back to confirmation bias. When you talk to because after the sort of the mechanics of the quantifying the biases, you then have to do the interviews, you have to get involved with the process of the asset manager, and then you have to try and help them change. It becomes more of a consulting kind of role that Behaviour Lab do. So it's a kind of from the start to the finish of the investment process, and results have been fantastic so far. We've taken some companies from being managers from being underperforming to being outperforming just by identifying some biases and working with them. So it's something that I think is going to get bigger and bigger and bigger, Steve. And I think it'll be very good for your business. I hope it will anyway, because I think there's a kind of growing awareness, particularly since the global financial crisis of over 10 years ago, that the industry isn't quite as smart and clever as we once thought it was.
No, it's very amateur.
Very amateur in lots of ways. If you look at the outperformance of the industry in aggregate, it doesn't exist because of fees. If you look at the number of funds or fund managers actually outperform regularly, and this goes back to the losers game, Charles Ellis again, there aren't many. I'm lucky enough to know quite a few in my 30 years, but there aren't many relative to how many fund managers I've met or seen. And I think that the missing link in the way that we've done things is this recognition of the psychology of our decision making. And I think that's something that's why I think that this behavioral science will grow in importance. And so anyone who's interested should speak to you about what you do, speak to me about what I do. Because I genuinely think it's better. Yeah.
I mean, myself and Mark are very much in that space of, we work with traders, and I work with some investors as well, and also leaders and people involved in sales roles, because these are all connected in some way, and you can really look at sport and the work sport has done over the past 30, 40 years. And, how do they keep, you can see the improvements in the way the game is played. It's not that people are any different physically, but they understand at a much closer level the importance of getting marginal gains and constantly trying to stay at their peak, trying to stay at their best. How do they make better decisions in the course of a game? How do they stop themselves being overwhelmed by emotions? And we had a brilliant podcast last year with a sports coach called Damien Hughes, who actually presents a podcast called the High Performance Podcast. And he was talking about these elements so often. He calls it tripwires, creating tripwires for his clients in the sports world, which is to get them to identify moments where they are, for want of a better word, losing it, which is really coming off process, which is what kind of behavioral finance is. It's signifying when people are coming off good process, the biases are starting to emerge and their process starts to fall apart.
Yeah, and you're absolutely right, because too often, I think in our industry, occasional good outcomes have masked a bad process, and people have been lucky. And I'm going to use that word because, and so that they've got 3 or 4 years of good performance behind them, which could be skill, that could be luck, but you probably need more than that in the investment management world to determine whether it's more likely to be skill or luck. And I think so. Recognizing that sometimes a good process can produce poor short-term results is important, because ultimately, if it's a good process, it will produce the better results over the long term. But not to be seduced by short-term, in my world, in the pension fund world, not to be seduced by short-term numbers, because there's always going to be someone that's done really well at the last quarter. and just be careful. And I think your point about sports psychology is brilliant, because it brings in the aspect of coaching, for which you can read coaching or consultancy. It brings in the aspect of analytics, using data. It brings in the aspect of physical fitness, and I think I know this is something that you guys believe in, but I certainly do. Is that you can't, if you, healthy body, healthy mind, and all that stuff. It does tend to work quite well. You can be, I think, more someone who takes, for example, regular exercise is probably in a better way, or goes for walks. That'll do. Go for a walk in the countryside or by the sea or around the town. Being able to clear your mind, and I think, again, the same sort of principle as a sports person, just making sure that they can focus at the right moments to focus on what they have to do. And so I think we're about 20 years behind the sporting world, by the way, on in terms of their psychology, but we're getting there. My favorite, and it is humorous. Do you remember there was my favorite sports quote was it was a press conference in 1980, and I remember I was quite into tennis at the time, and it was Vitas Gerulaitis, and he had just beaten Jimmy Connors in 1980. And at the press conference, he actually said this, which is so brilliant. He said, "And let that be a lesson to you all. Nobody beats Vitas Gerulaitis 17 times in a row."
Oh, that's great, because you've taken me back to my youth. I actually saw Vitas Gerulaitis versus Borg at Wimbledon. Just giving a kind of sense of my age there.
Oh, brilliant!
But,
I mean, you could argue that's an exercise in resilience, which we know is very important.
I suspect, in a sense, that ego has got in the way of them actually coming to the surface. Up until sort of quite recently, when we start to understand that ego is blooming dangerous, and that to put a trade on requires some degree of ego, as we've sort of discussed in some of our podcasts. But if you don't lose it quickly, if you don't get back to a sort of an optimal state where you're much more aware and in control of yourself, then the chances are that ego is going to lead you into all sorts of trouble where you can't let go of the trade. It just hangs around, and you start to understand that it becomes almost defeatist in the way that you're approaching trading in general. So I always see it as we've got this optimal operating temperature that's a nice sort of 21 degrees, where we have to get up to about 38, 40 to make decisions. But if we constantly stay at 38, 40 and do nothing about it, then the chances are that we're not going to see, the reversal of the trade. We're just going to hang on for it for too long. And certainly from the discussions we've had across pretty much most of our guests, really, it's this, what's almost been written in books that's been in books for a long, long time, is now starting to surface into the real world and being applied. Far too late for the crisis that we've had to suffer in the meantime. But it's good that we're starting to talk about it, and certainly from some of the things that you've referred to in the past of System 1 and System 2 thinking, those types of thought processes. Realizing that System 2 is a far more effective way, but actually, City of London, you just look at it and think very, very, cities anywhere, very, very System 1 in its approach.
Yeah, so I've always liked the metaphor that, again, it's Jonathan Haidt, the psychologist I quoted earlier. He uses this idea of the elephant and the rider, and the idea being that your conscious mind, the one you think you're using all the time, the logical, analytical, data-driven, clever mind, it is like the rider sitting on top of an elephant, and your unconscious mind is this huge elephant sitting below you. Now, normally your unconscious mind is quiet. You almost don't know it's there. It's the proverbial elephant in the room, but you almost don't know it's there. But if that elephant gets roused, it can be very, very powerful indeed, your unconscious mind. And so the idea being that if you're sitting on top of the elephant and you can have a strategy as the rider, you can want to go over there, you know where you want to go, you have vision, you have worked it out, you've done this map reading and everything. But the old elephant wants to go the other way because it's seen a water hole, for example, it's thirsty. Which way are you going to go? And I love that metaphor because it reminds me of how powerful the unconscious mind is. And indeed, of course, your biases, your heuristics, your mental shortcuts tend to come from the elephant because it tends to be where your emotions and your instincts and your habits come from. And so I remember that I was talking about this metaphor to a bunch of CEOs once, and a CEO said, "Look, I kind of get this idea, Paul, but I think I can control my unconscious elephant. I think I can control my unconscious mind." And I politely pointed out to him that I'd first met him earlier that day. He was outside smoking, and I wondered whether smoking was a rational, data-driven, analytical decision, or whether it was just a habit. And he said it's a habit, in which I said it comes from the elephant. Pretty powerful, isn't it? I noticed he bit his fingernails. That's a habit. And so again, it's the elephant is where the instincts come from. I do an experiment where I sometimes go. I literally go. There used to be a poster, a railway station used to say, "Beware pickpockets," in about 6 or 7 different languages. And I used to stand by this poster many years ago to watch how people reacted. And it's just brilliant to see. You see people coming down in a sort of busy crowd, and as they eye this poster up, and this particularly of men, I might point out, if a man sees a picture saying "Beware of pickpockets," they will automatically tap their pockets. And what that says to me is, if you were that's the elephant reacting, right? It's the instinct. Now, why would you bother? If the wallet's there, it's there. If it's not there, it's not there. You can't do anything about it. But all you're doing by tapping a wallet is actually showing a potential pickpocket who's standing by the poster. That wasn't me, by the way. Where you keep your wallet, so it makes it much easier to lift it out. So again, it's quite normal. It's quite human. It doesn't necessarily. You can't really call it irrational, because it makes sense in a sort of ancient way. But if you really are trying to engage your neocortex part of your brain, you'd say, "I mustn't tap my wallet around here, because there are people might be watching to see if I'm tapping my wallet." So it's this idea. So this is where I'm kind of back to where we started. The whole, some things make sense, but in a different environment, they don't make sense. And one of the reasons that I love magic, for example, I'm a member of the Magic Circle. You very kindly mentioned it earlier, is because for me, I think, well, I'll quote Teller of Penn and Teller fame, who you probably heard of. Teller said, "The core of every trick is a cold cognitive experiment in perception." Now, if that ain't behavioral science, tell me what is, because that's what we're trying to do. We're trying to work out how we perceive things. We're trying to look at our cognitive processes. We're trying to work out how we make decisions, how we analyze things. Well, there's a lot of magic that we try and use that the way the brain does and doesn't work. I mean, I do an afternoon speech called "Your Mind Plays Tricks," in which is a sort of 15 to 20-minute talk about behavioral science. But I'll throw in 3 or 4 visual tricks that the people sitting around the dinner, and it's been a while since I've done that for obvious reasons because of COVID. But in the days when we used to have dinners, it would be a thing I could do and show people with a little bit of entertainment how your mind plays tricks. And then when you get that into sort of the world of finance and investment or decision making or sales, you can begin to see pretty quickly how easy not just the mind can be fooled, but how you can fool yourself. So watch out. There are lots of lessons to learn from behavioral science.
Hearing this, and you alluded to, you wanted to speak a little bit about luck and chance earlier on. And if I go back to the conversation we had earlier on about economists and analysts, and how a lot of them actually, the ones I know who are really good, actually don't believe they'd be that great at trading or even investing, which to me speaks of some great self-awareness on their behalf, which is maybe why they're so good. I've noticed over the years, and I'm probably just stream of consciousness here. You're talking about luck and cognitive biases and illusions almost. And I've noticed how poker players so often make great traders and great investors as well, though perhaps more traders. And bridge players may be investors. It's that ability to cut through some of this stuff and actually see the reality and not be fooled by it, and not to fool themselves as well, which is a key skill in games, really. And I know my colleague Mark up here often talks about the gamification aspects of these activities, such as trading and investing.
Yeah, I mean, poker players are. I've seen some data actually of how poker players do have the same sorts of ways of thinking as good investors, and you probably possibly traders as well. And also the idea of keeping your nerve at the right moment. And also, let's not forget it, of working with the cards you're dealt with. It's not like you can skillfully acquire all the best cards. You have to play. You have to gamble in that sense, but you and I might call it invest in a more professional sense. You have to invest in the cards you're dealt. And I think it is interesting. And I suppose the most skillful game, though, this is interesting because Michael Mabusson is very good on this in his books. Talks about the luck and skill and how we identify both. And you may recall, he's got this famous continuum line where he puts something he thinks is really, really skillful at one end, and he talks about chess. Interestingly, chess obviously probably even more so than bridge or poker, because you really are. Well, that's probably about as close to 100% skill as you can get. And then he goes to the other end of the continuum, going down through different sports and indeed going down through investments, which is below halfway, right the way down to something that's pure luck, which he looks at. He says roulette, take roulette. And so the issue is, how do you determine where on your luck skill continuum is an industry? Or, and this is where it's fun, where do you put your role and responsibility on the luck skill continuum? Is what you do skillful or lucky, or where does it fit in terms of the whole continuum? And the book is brilliant, and I'd recommend it. It's on my reading list. I have about 12 books that I always recommend to people after my talks, and Mabusson's would be up there. And the question you need to ask, he says, which is genius, I think genius, is how easy would it be for you to perform badly? So let's just take those two extremes. A chess player. So you're talking to a grandmaster. How easy would it for you, grandmaster, to play badly? Answer, very easy. I'd just play some bum moves. I'd do some deliberately stupid stuff. I'd lose my queen pretty early. I mean, I could deliberately lose. And, someone like Usain Bolt, who's probably right up near the top end of the skill thing, could just run a bit slower. But can you say to someone that goes to a casino, can you deliberately lose? And the answer is no, you can't. You probably will lose, but you can't deliberately lose, because there's always games of chance that you could win. And so what Mabusson says is the easier it is to deliberately do badly, deliberately lose, the more skillful your job probably entails. And it's a wonderful way to ask, again, not trying to catch people out, but just to understand their cognitive thinking. So when I work with I was working with in a room full of fund managers once, and I just asked the question: look, if I gave you a benchmark, the benchmark you've currently got, could you deliberately underperform on a 3-year view? Deliberately underperform, and you've still got to hold your 80 to 100 stocks, and you can't have it all in one stock or something. You've got to basically run money in the same way you'd run money to outperform. Can you deliberately underperform? And of course, they should immediately say, yes, of course I could. But you know what? They had to think about it. And the very fact they're thinking about it actually means that they're not sure they can outperform. Now, again, I'm only highlighting one example of almost a hypothetical example that did actually happen. But it's a way of finding out how people have belief in their own abilities. Do they have the sort of skin in the game intellectually that they can outperform? Because you could ask them, could you underperform? And they should say, yes, of course I could. And I think, again, I'm not trying to catch them out. I'm trying to help people recognize that behavioral science is a great way of revealing some of our hidden mental shortcuts, if you like. And on that whole sort of luck skill thing, so Mabusson puts the industry nearer the luck end than the skill end after fees. In other words, there's more luck involved with the numbers, and it goes up. So the more you got then through the team sports towards skill, then you get to the individual sports where there's more skill still because there's less reliance on others. And then you get to the very top, which he puts chess at the very top, the most skillful thing possible. But it's a fantastic book, Michael Mabusson's Success and Luck book.
Success equation, isn't it?
Success equation, that's it. It's a really, really, and it taught me so much. And again, I don't think Michael talks a lot about behavioral science per se, but it's full of behavioral science, behavioral finance. Yeah. And it kind of goes back to, I don't know, it's hard after sort of 30 years in the city, and then, having had some good days and some bad days and some good years and bad years and all that, to think about what works for people and whatever job they do and any job in life. And I come back to this idea of people actually are asked, what makes success. I think it's a three-pronged occasion. Success equals talent plus energy plus luck. And anybody who gets to the top or even does moderately well in life really probably needs to acknowledge the role of luck, just as people who don't do well sometimes have too much bad luck, as it were. But I think talent 1, energy 2, and luck 3, and there's a sort of pie chart, and you just hope that the the talent and energy will dominate if the luck is going to be bad, but sometimes luck can be good and dominate the pie chart. So that's kind of my formula for life.
I think the skill in trading and investing, probably, this is one of the things which I believe is actually about making luck work for you.
Yeah, which goes back to the poker point, doesn't it? About you've got to play the cards you're dealt with, I think.
Yeah.
But if you kept on getting bad cards constantly, which is possible, it's going to be very hard, though, Steve. And I think that's the point about it is that some people do appear to have bad luck, but there's been lots of work on this, lots of psychology work. Richard Wiseman, the psychologist, is brilliant on this. His book, The Luck Factor. If people feel unlucky, they will tend to be more unlucky, at least in their own heads. And it'll end up like, if people feel lucky, they'll tend to be more successful. Don't take my simple one sentence explanation of his book. Go and read his book and see the data behind it. It is fascinating.
What's his name?
Richard Wiseman. He's a psychologist. He's also a magician. He's a very good magician. But it's called The Luck Factor, and it's brilliant.
So I talk about this often in my coaching work with people because, edge and mindset are big parts of our work, and I know it's a big part of Mark's work as well. And I've noticed over the years how some of the most successful people are able to remove themselves from unfavorable situations far quicker than other ones who hang on into them, kind of going into the sort of hoping it's going to turn around. We're almost moving towards sunk cost fallacy now, whereas the other ones will realize that they're in a losing position. And if they're not careful, their mind is going to go and they're going to accentuate that losing position themselves. So it's almost like that's one way of making luck work for yourself. And it comes back to that losing thing, removing yourself from losing situations.
Yeah, I think it's also if you're sensing that you're always unlucky, your mood is going to be low. You're going to be slightly negative about things in general. Your awareness is going to be much more constrained to almost just thinking within your head about what am I doing wrong. Whilst I think when you have a positive, engaging mindset that feels that you can win things more often than not, particularly from a sense of being lucky, then I think you do have a greater awareness, and you're more looking out for opportunity. Whilst I think people that feel they're unlucky don't tend to look out for opportunities. I don't think there's opportunity out there, and it changes just a skew of thinking. And of course, if you look at the retail trading community and ask the question about luck, if 95% of people are not making money and are losing, then does that mean that 95% of retail feel that they're unlucky? And that actually, if they start to modify their process and start to win in a very phased way of winning, rather than little and often, rather than massive chunks of win that we know is more unlikely than not, then will they sense that they're becoming lucky? And because they sense they're becoming lucky, they start to see opportunity. I think there's a bit of a loop that works well, and it's all down to just your own personal setup and mindset. If you're not paying attention to it, then you've got a slight negative bias anyway that might start always work against you.
I think that's absolutely right, Mark. And I often revert to the and this is particularly for people that feel down on their luck. And again, I'm taking this outside the sphere of just trading, but people who is to something that Kahneman said, and I think it's probably amongst the many brilliant things he said, it's probably the most brilliant thing he ever said. He said, nothing in life is as important as you think it is while you are thinking about it. So anybody that's suffering will be obviously focused entirely on their predicament. But what I try and do with people like that is to say, in 6 months' time, it will be very different. You'll look back on this and it won't seem quite as awful or important as it does now. And again, this idea, coming back to the trading point of can you take some emotion out of it? Because as long as you're emotional, you won't behave in a way that may be optimal. And it applies to trading, investment, and the sort of greater things in life. And I do think that it's important to remember that nothing in life is as important as you think it is while you're thinking about it. It's a great piece of advice, that, particularly when times are tough.
Paul, before we get close to wrapping this up, and I know we're slightly over time here, um, I'd love to perhaps if you have a list of you mentioned the Dirty Dozen a few times from the work you're doing with behavioural labs. Do you have a list of those at all that you could just share with us?
Yeah, sure, sure. What I'll do is I'll put it on a tweet to you after we finish now, and let you see it, so then everyone can keep it as a record. But yeah, that'd be fun to do.
Okay, so I'll put it on the episode notes page and the blog page for the episode as well.
Why not? And I mean, for example, there's confirmation bias in there. There's anchoring. There's the endowment effect. There's loss aversion, the status quo bias, regret aversion. I mean, there's 6 or 7 off the top of my head, but gladly, yeah.
Yeah. Okay. And also maybe you could just let people know again how they can get in contact with you if they're interested in your work or find out more about you. And you've got a great TED talk which you did at London Business School, which we'll also put the details on the webpage for people so they can see that. I thought that was terrific.
Oh, thank you. That was a while back. I've got a bit grey since then, I'm afraid. But haven't we all in the last year? Yes, there's a few talks about online. I tweet regularly as Craven Partners. Craven, and my website is paulcraven.com. And please, if anyone wants to get in touch with me, it's paul.craven@me.com. And I'd love to hear from you, particularly if you're interested in working together or after dinner speeches or conference talks, or and particularly about Behaviour Lab. If you want to hear about that as well, that would be very interesting to take that discussion further. But thank you very much indeed for having me. I really appreciate it. And perhaps one piece of advice to finish up. I think everyone benefits from having passions outside their work. So obviously you mentioned mine is magic, and that's something I also do. That's my kind of indoor passion. But my outdoor passion, which is a bit weird, and this is weird, is playing not just golf, but hickory golf using clubs that are over 100 years old, which get refurbished. And tell you what, you learn more psychology on a golf course than anywhere else indeed. But I'll leave you with the words of Walter Hagen, who said, "You're only here for a short visit, so don't hurry, don't worry, and be sure to stop and smell the flowers along the way." Thank you for having me, gentlemen.
Thank you for listening today, and thank you to this week's guest. You can find more information about our guests on the blog page which we produce for each episode on the AlphaMind blog. Thank you to our podcast partner, the Society of Technical Analysts, the STA. If you are enjoying our podcasts, you may be interested in our one-to-one performance coaching programs for traders and investors. These programs have been delivered to clients over the past 10 years at some of the world's leading investment banks, hedge funds, asset management firms, commodity and energy trading businesses, and proprietary trading firms, as well as to many serious retail traders. The programs focus on self-optimization of the human aspects of performance and the mindset and mental effectiveness aspects rather than the technical aspects of trading and investment. If you are interested in learning more about these, please email info@alpha-mind.net or go to the page link on the AlphaMind blog. We would also be delighted if you could leave a rating or review of this podcast with whichever podcast service you use. Ratings and reviews help more people to find out about the AlphaMind podcast. We now also have a YouTube channel, so you can listen to the podcast on YouTube, and we are starting to roll out past episodes of the AlphaMind podcast on our YouTube channel. We have also recently started a newsletter. Please go to the AlphaMind blog where you can sign up for this. Finally, if you aren't yet following us on social media, you can find us on Twitter at AlphaMind101 and at AlphaMind102. Co-hosts Stephen Goldstein and Mark Randall are both available to connect with you on LinkedIn, and we run an AlphaMind LinkedIn group with over 15,000 members which you can join. As a reminder, our website is alpha-mind.net and our blog page is alphamindblog.blogspot.com. Thank you once again for listening, and have a great week and stay safe.